Bond investors have been just as disappointed as equity investors this year. They've had to accept equity-like declines in their bond portfolios. When you look at a broad bond index, it's on pace to have its worst annual decline on record. Unfortunately, the Federal Reserve is not going to stop raising rates until they can get truly ahead of inflation. That means that interest rates are going to go higher, specifically in the long-term part of the yield curve. So 10-year, 30-year bonds, these types of bonds, we still think have a lot of pain to endure before we can say we're out of the woods. Within fixed income, there is opportunity, though. We do still think there is some diversification benefit here. Short-term bonds. When you look at this chart, the yield curve, or the difference between the 10-year yield and the 2-year yield, this is now at the widest levels we haven't seen since the mid-1980s. That means that you're getting better yield for your short-term bonds than you are for long-term bonds. And short-term bonds are less interest rate sensitive. So we would focus on that short-term part of the bond curve. Credit, there is yield in credit, but at this point, we're not there yet. We actually think there's some complacency in the credit market. We haven't seen yields rise enough to really reward investors for that extra risk, because typically with economic downturns, you will see some level of increase in defaults. That's not being priced into that market. Eventually it will, and we'll look for opportunities there, but for now, stay defensive in not only your maturity range, but also in your credit quality.